Hi guys, as Mr. Gurney said, I'm from his Period 1 class and my name is Jazz. And today I will be presenting for you the Jenkins Fund. And you guys are probably very surprised to hear that my uncle Vladimir the Ninth recently passed away and left me $100,000 to invest into the stock market. I named my fund the Jenkins Fund, but also known as the second place is the first to lose fund, because in my period, in my period I was, my portfolio ended in second place, bested by Matthew Carter, who beat me by $250, so I was very close to getting dinner with Mr. Gurney, but I didn't quite make it. So the major thing I focused on when preparing my portfolio was diversification. I think that that's very important in a portfolio because during the time that we invested, I wasn't sure at what point in the business cycle we were in. So what I did here was I invested in these 5 stocks: Coca-Cola, PSEG, Royal Caribbean, the Toro Company, and Facebook. And as you can see, I labeled them each. They're all from very different sectors, so I didn't have any overlapping sectors, so I could reap the benefits of the entire market. While I'm presenting my portfolio, I ordered it from the least capital gain to the most capital gain. So I'll be showing you my stock that did the worst first, and then we'll end on a happy note at the end. So firstly, Royal Caribbean. This was my dog stock. It was the worst fund in my portfolio. Royal Caribbean is a conglomerate of the 3 largest Norwegian cruise lines that were merged in 1968. The reason they merged is because they wanted to get in on the American market, because in the 50s, the United States was at a peak in the business cycle. So there was a lot of expansion and a lot of interest in luxury markets. So that's why they decided to make Royal Caribbean. It went IPO on the New York Stock Exchange in 1993, and because they wanted a piece of the American market. And this here is the newest of the boats added to the Royal Caribbean's line, which is 25 ships. It's called Symphony of the Seas. So why did I purchase Royal Caribbean? So as I mentioned before, when I started this project, I wasn't sure where we were in the business cycle. So I just decided to dedicate half my stocks to an expansionary phase market and half my stocks to a contractionary phase market. So this was my first expansionary phase stock. The reasons I thought we might have been in the expansionary phase was because as of September 7th, 2018, unemployment was at its lowest in 49 years. It was at 3.9%, and so that's always a good sign in terms of expansion. We've also been having a lot of real GDP growth in recent years. Under Trump's presidency, that's been something he's been boasting about for a while, that our GDP has been growing. And lastly, we have a very strong dollar recently when we started investing in October. And so these were the 3 reasons that I thought we might be in the expansionary phase that I circled here. And so when we're in an expansionary phase, a really good sector to invest in is luxury goods. So I knew I needed to have my eye on a luxury product, and so I chose Royal Caribbean, the cruise industry, because of crude oil prices and an increased demand for leisure. Crude oil prices is because when I'm looking at a graph of crude oil, it was at its peak in October, and you could see that right when we started to invest, it started to decline. So I thought that in the months of the investment period, crude oil would be getting cheaper and cheaper, which is a very important resource for Royal Caribbean, as their cruises use a lot of fuel. So I thought that that would be a reason to invest in Royal Caribbean. So you can see that Royal Caribbean was my dog stock here. There was a lot of volatility going on, and so I'm just going to point out 3 major points. Firstly, there was a general market decline, as you see here, and luxury goods tend to follow the trends of the market that they're in. So right when we started investing, I'm sure you all know because of your portfolios, the market was doing terribly, and so luxury goods tend to follow that trend, so that's why we see this dip here. And then Royal Caribbean released its quarterly earnings on October 26th, and they did not perform as well as everyone had hoped. They beat expectations, but they had bad forward guidance going into the end of 2018, so that was not a good sign for investors. And then lastly, if we go to sort of the end of the investment period, the Crown Prince of Saudi Arabia announced that he would be cutting exports to the United States and internationally of crude oil because of increased tensions with Russia. So you can tell that an international an international experience over in the Middle East was affecting the market here. So that's what we see here. I bought Royal Caribbean at $129.65, sold it at $104.92, and I lost $3,842.32, which was my biggest loss of our investment period. So that is Royal Caribbean. Next, can I ask who here has a Facebook account? Okay, yeah, and then whose parents have a Facebook account? Yeah, so Facebook is a huge company. Facebook was founded by Mark Zuckerberg in 2004, and his friends, who were all college students at Harvard University. They started, it's their first website in their dorm room, actually, so I think that's pretty cool. It went IPO in May of 2012, and it had raised $16 billion by the time it went IPO, and had a market value of $102 billion. Just for a little bit of comparison, Google, which previously was the biggest internet company to go public, had raised earnings of $1.9 billion when they went IPO, and you can see by comparison that Facebook beat them extravagantly. So this was a huge company to enter the market. And on its first day of trading, Mark Zuckerberg held $19 billion of shares by the first day. So that's a really big deal for Facebook entering the market. So why did I invest in Facebook? This was my second stock that I chose to invest in because I thought we might have been in the expansionary phase. And tech stocks is always a good type of stock to invest in during the expansionary phase. And the reason I specifically chose Facebook is because it is a FANG stock. FANG stands for Facebook, Apple, Amazon, Netflix, and Google. These are the powerhouses of the tech sector. And I chose Facebook specifically out of these five because Facebook has room to grow, in my opinion. Earlier this year, they were involved in a scandal with Cambridge Analytica, which is a information technology organization, and Facebook had leaked a lot of information of its private users, which was a really big deal. And earlier this year in April, their stock fell a lot, but it rebounded after that. So it's on a steady growth kind of trend when we started investing. So I thought that as opposed to Amazon, Apple, Netflix, and Google, Facebook had room to grow. So that's why I invested in Facebook. I was wrong when I made this investment. At the beginning of our period, there was a tech market self-correction, which means that all of the FANG stocks were adjusting to the new trends of the market. Because since the tech sector is very volatile, it depends a lot on how the entire market is doing. So Facebook followed a lot of the other big tech names. And one of the biggest things with Facebook is that it engaged in a lot of sympathy trading over the period. So sympathy trading means that a company's performance is based on how other companies in the same sector are doing. So the first big dip we see is sympathy trading with Netflix, who they reported earnings that fell short in revenue. And so Netflix tanked a lot during this time, and Facebook went with it. And then secondly, there was sympathy trading with Apple, who also released earnings, and their stock dropped more than 6% after decreased demand, which was the largest drop in all of Apple's history. So Netflix and Apple were big contributors to how Facebook did over this period. I bought it at $161.22, sold it at $137.42, and I lost about $3,000. So that was my second biggest loss that I wasn't very happy about. And now we kind of get into the better side of things, but still not great, with the Toro Company. So the Toro Company is my smallest investment. Something I thought was very important was to have at least one kind of small name to invest in, just so I can have diversification not only in sector, but diversification within size. So I invested in the Toro Company, which was founded in 1914 as a leader in the tractor and fieldwork sector. And then eventually in the late 1910s, they moved on to mowing. And they actually developed, this is just a fun fact, the standard golf machine, which is what almost every big golf course uses to turf all of their hills and valleys. So yeah, so if you go to a golf course, they're most likely using Toro's standard golf machine. So that's a really important patent they had. They went IPO on January 13th of 1978 with a market cap of $5.9 billion, which sounds like a lot, but that is my smallest. So that is the Toro company. The reasons why I invested in Toro. So as you can see before, I had this area circled before, but now this is the contractionary phase. So as I mentioned a couple of times, I wasn't sure if we were going into an expansionary phase or contractionary, so I chose to safeguard myself and invest in some companies that I knew would do well during a contractionary phase. And Toro is the first of them. So the reason I thought we might have been going into a contractionary phase are because of interest rate hikes by the Fed. When inflation is happening too much in terms of United States currency, the Fed, as you probably learned with Mr. Gurney, changes the...
Liang-Fu, please come to the main office. Joe Liang-Fu, please come to the main office.
Adjusts interest rates to try to fix that. And then also, slowing growth in our economy. So though GDP has been growing increasingly over recent years, every year it's been growing a little bit less for the past 5 or 6 years. So I felt like that might be a sign that maybe we're at the peak of the business cycle and we're going to start going into a contractionary phase. And then lastly, the trade war with China. Donald Trump has advertised this trade war with China as something that will stimulate our economy, but it's been shown in history, which is a presentation I actually gave a couple weeks ago in Mr. Gurney's class, that trade wars only, most of the time have a negative effect on the economies of the countries that participate in them. So these were the 3 reasons I thought we might go into a contractionary phase. So as a result, I invested in a domestic manufacturing company like Toro. Some of the reasons for that is that Donald Trump's tax cuts said that manufacturing goods would be 100% deductible in his new recent tax plan, so I thought that was very interesting. And then also Hurricane Florence. Toro does a lot of work on tools that rebuild and manufacture, so with a lot of the damage from Hurricane Florence, I thought that this might be a profitable sector. And then, so those were the primary reasons that I chose Toro. Toro's performance was not bad. As you can see, we had a really good period here, but then right at the end of our investment period, they fell back down, which wasn't too bad, but I kind of wish we might have ended over here. So firstly, Toro paid its first dividends on October 17th of 2018, and they were only 4 cents, but a company beginning to give out dividends shows that they are stable, and that's very attractive for investors, and that their dividends may grow in the future. So that was something really good. And then the October labor statistics report came out in early November, which said that construction and manufacturing was the largest growing sector in our economy as of October, with 30,000 new jobs in that sector. So that really did well for Toro, and a lot of people, especially because of the volatility in the tech sector, moved over to domestic manufacturing. And then lastly, the thing that brought my stock down, which I wasn't too happy about, was the G20 meeting between Donald Trump and Xi Jinping of China in Argentina. They decided to lessen the severity of the trade war with China, so that means that manufacturing might go back to being an international, might be based internationally, whereas before, during the trade war, it was based in the United States, so that wasn't that great for Toro, but it didn't fall that much. So my buying price was $59.39, sold at $58.53, and I only lost about $300, which isn't great, but compared to Facebook and Royal Caribbean, I wasn't too mad about that. And then my next investment was the Public Service Enterprise Group Incorporated, which is a diversified energy corporation, and it's ranked in the top 10 largest companies in the world for energy. It was founded in 1903 after a merger of the 10 biggest energy companies in the northeastern region of the United States back in 1903. It actually went IPO on the same date as the Toro company, which is a pretty weird coincidence. I don't know about that, but I thought that was pretty interesting to bring up. And currently it amalgamates 400 different energy companies in the northeastern region. So it's a huge powerhouse in terms of energy. And it's also diversified in its pursuits. So it not only provides energy like you and I use and our school uses, but it also provides nuclear energy and a lot of different chemical energy holdings, so PSEG. This was another one of these stocks that I chose because we might have been going into the contractionary phase. Interest rate hikes, slowing growth, trade war, we all talked about